Welcome to Iron Financial. This is the only place on the street where we forge a stronger portfolio by stress testing market weakness. I'm your lead analyst. Today, we are putting on the hard hats and running a full structural analysis on Velo3D, ticker VELO. Now, the markets saw their latest earnings report, and frankly, it ran for the hills. But we don't run, we inspect. This isn't about hype or headlines, it's about the numbers, it's about the strategy, and it's about whether this company is actually built to last. Let's get to work.
So let's just get right to it. Velo3D's Q4 2025 earnings, well, on the surface, they were a complete demolition job. The stock got absolutely hammered, and you know what? For good reason. The headline numbers were just the facade, and that's exactly where I come in. I'm your market skeptic. I'm here to ask the tough questions because we are not just glancing at the paint job today. Is this company really built on solid steel, or are we looking at a foundation that's just riddled with cracking concrete? We're about to conduct a full structural stress test on every single part of this corporate structure, from the ugly, visible cracks in the financials, all the way down to the steel foundation that management claims is hidden deep below. Let's see if this thing is built to last or if it's about to collapse. Okay, let's dive into this. Section 1, the shaky blueprint. You have to understand, Velo3D came to market with this grand vision, this idea that they would completely revolutionize manufacturing for the most demanding industries on the planet. We're talking aerospace, defense, space exploration. These are mission-critical parts that simply can't fail. So the blueprint itself was incredibly ambitious, a true skyscraper in the manufacturing sector. A skyscraper or a house of cards? Because the second the market got a look at those Q4 numbers, it treated it like the ladder. I mean, investors didn't just walk away, they fled. The immediate question wasn't about some grand vision anymore, it was about basic survival. Is this blueprint for a future titan of industry, or is it just fundamentally flawed from the ground up? All right, now it's time to get our hands dirty. Section 2, inspecting the Q4 damage. Any good inspection has to start with the most obvious damage, and for Velo3D, that is the top line revenue. This is the first crack everyone saw, and believe me, it is a big one. And there it is, $9.4 million in Q4 revenue. Now, for a company that's supposed to be in a high-growth sector, this number is an immediate code red. It's not just about the number itself, it's about what it signals. It signals a potential stall in customer adoption, it signals massive execution problems, and in a market that just punishes any sign of weakness, it's a signal to sell first and ask questions later. This wasn't a speed bump, this was a screeching halt. A screeching halt is putting it mildly. Come on, this isn't some hairline crack. This is a chunk of the wall falling off. A 25% year-over-year decline. In the additive manufacturing space, if you're not growing at double-digit rates, you're already falling behind. Going backwards by 25% is a catastrophic failure. Now, management can blame a government shutdown and product mix all they want, but to an investor, that just sounds like excuses for a significant structural failure that's right there on the surface for everyone to see. And if the revenue drop was the crack in the wall, then this number, this is the sinkhole that just opened up in the foundation. This is the number that turned a bad story into an absolute horror story for investors. A gross margin of negative 73.6%. This is what caused the real panic. How is that even possible? A negative 73% margin? Are they literally paying customers to take the machines off their hands? I mean, it's one thing to be unprofitable on the bottom line while you scale, that's expected. But to be this unprofitable on a gross level suggests a business that is fundamentally broken at its core. It means for every dollar of product you sell, you're spending $1.73 just to produce it. No company can survive that. How does any management team even begin to justify that number? Okay, here's the official explanation from the foreman on site. The acting CFO, Bernard Chung, points directly to a $7 million inventory write-off. He frames it as a strategic one-time cleanup, a non-recurring charge to clear out older systems and parts to make way for the new year. So the argument is that this isn't some systemic operational flaw, it's just a one-time financial hit to clear the decks for future profitable growth. That's standard CFO speak for a major operational failure. Calling it non-recurring doesn't change the fact that they mismanaged their inventory so badly they had to light $7 million on fire. That's not just sweeping some dust off the floor, that's a massive hazardous waste cleanup. It signals deep underlying issues with their sales forecasting, their supply chain management, and their production planning. It tells me the people running the site miscalculated so badly they had to throw millions of dollars of product in the dumpster. That doesn't inspire confidence. That tells me the rot might go much, much deeper than just one quarter. That's a fair point. The surface damage is ugly. There's absolutely no denying that. But any seasoned builder knows you don't condemn a building just because of some drywall cracks. You have to inspect the foundation. And for a company, the foundation is its balance sheet. So let's move to Section 3, reinforcing the foundation. This is where management claims the real load-bearing steel is actually located. And here's the first pillar. While the market was fixated on the income statement carnage, Velo3D executed a critical maneuver to reinforce its core structure. They took their total debt load from around $25 million down to just $10 million. That's a massive 60% reduction. In a rising rate environment where debt can be an anchor that literally sinks a company, this is a huge move. They didn't just patch the cracks, they took an enormous amount of weight off the entire structure, making it far more stable and resilient for whatever comes next. Look, a 60% debt reduction is impressive, I'll grant you that. But let's be crystal clear about the cost here. They converted debt to equity, which dilutes existing shareholders. But the counterpoint to that is incredibly powerful. The new CEO, Dr. Arun Jeldi, personally acquired and converted a significant chunk of that debt himself. And look at the price, $16.38 per share, a huge premium to where the stock was trading. This is a classic, high-conviction insider move you see in serious turnaround situations. This isn't just some financial transaction. This is the lead architect buying into his own project at a premium, while everyone else is panicking. It's one of the strongest signals of insider confidence an investor can possibly ask for. And here's another key pillar of that foundation. They ended the year with $39 million in cash. Now, after the absolute beating they took on gross margins, the market expected the coffers to be nearly empty. Instead, they have a solid cash position. This cash is their runway. It's the capital that allows them to weather more construction delays, to invest in their new strategy, and most importantly, to prove to their huge defense clients that they are a stable, long-term partner. This isn't a company on the brink of collapse. It's a company with the fuel in the tank to actually execute its turnaround plan. Okay, so if the debt reduction is the concrete and the cash is the fuel, this right here is the steel rebar holding it all together, a record $31 million backlog. Now, this isn't just a sales pipeline or some theoretical future business. This is contractually secured, locked-in future revenue from top-tier customers. While the Q4 revenue number was falling off a cliff, their pipeline of future, committed work was growing to the largest point in company history. This is a critical divergence. It suggests that the end users, the aerospace and defense primes who are actually using the technology, they are not spooked. In fact, they're signing multi-million-dollar deals and doubling down on the platform.
So, with a reinforced foundation, the focus now has to shift to the new construction. How are they going to build their way out of this mess? That brings us to Section 4, building the growth engine. This is all about their strategic pivot and their official blueprint for the future. And this chart tells the whole story. Velo3D isn't just dabbling in defense anymore. They are betting the entire company on it. Defense now accounts for over 56% of their revenue. This is a massive strategic shift. They are consciously choosing to become a critical supplier for the U.S. defense industrial base. It's a high-stakes, high-reward strategy. The sales cycles are long, and the qualification process is brutal. But if you win here, you get long-term, sticky, high-margin contracts that are pretty much insulated from economic cycles. You fail, and there is no plan B. But look at the evidence that this pivot is actually working. These aren't just bids, they're major strategic wins. A $32.6 million project with the Department of War, an $11.5 million multi-year production contract with a major prime contractor. And maybe the most important credential here, becoming the first additive manufacturing vendor qualified by the Army's Ground Vehicle Systems Center. These are not one-off sales. They are deep technical integrations. They are systematically building a competitive moat right inside the U.S. defense apparatus, making their technology mission-critical and incredibly difficult to replace. And here it is, the official blueprint for the rebuild. This is management putting their reputation squarely on the line. They're guiding for $60 to $70 million in revenue for 2026, a significant jump. More importantly, they're guiding for gross margins to swing from negative 16% to positive 30% in the back half of the year. And they are guiding for positive EBITDA in that same timeframe. This is their public plan to go from a demolition site to a finished building in just 12 months. This is where the stress test gets real. That isn't a blueprint, that's a prayer. Just look at the chasm between 2025's reality and their 2026 targets. They expect to grow revenue by up to 50% while simultaneously executing a nearly 50-point swing in gross margin. And hit profitability? Show me another capital equipment manufacturer that has pulled off that kind of turnaround in 12 months without some form of accounting magic. The execution risk here is absolutely astronomical. This requires flawless performance, a perfect product mix, zero supply chain issues, and zero delays in those government contracts. It's a heroic forecast, and I have to question if they have the operational discipline to pull off that kind of heavy lifting.
And that execution risk is the absolute core of this entire debate. It's the primary risk factor. But to understand why any investor would even think about taking that risk, you have to look past the 2026 blueprint and see the architect's final vision. So, Section 5, the skyscraper vision. What is the ultimate payoff for enduring all of this construction noise? Here's the scale of the ambition. The long-term plan, which is driven by what they see as compounding demand from their core defense and aerospace customers, is to have up to 400 production systems in operation over the next decade. At over $1 million per system, plus all the recurring revenue from service and materials, you're talking about a business with a multi-billion-dollar installed base. That represents a fundamental shift in manufacturing capacity for their clients and a massive recurring revenue opportunity for Velo3D. And this is just peak hype. The AWS of manufacturing. You know, I have a file of companies that have claimed they'll be the AWS of their industry. Most of them are now defunct. It's a grand, speculative vision that sounds great on an earnings call, but is incredibly difficult to execute. It sounds more like marketing to pump the stock than a grounded business plan. Every industrial company wants to be a recurring revenue data company, but very, very few ever succeed. I agree, it's speculative. It's the penthouse suite of the skyscraper that doesn't even exist yet. But for a high-growth, high-risk investment, you have to show investors the potential view from the top to convince them to even get in the elevator on the ground floor. This vision, however ambitious it is what frames the bull case. It defines that multi-bagger potential. If they can execute their defense strategy and achieve even a fraction of this long-term vision, the payoff for investors who stick it out through this current construction phase could be enormous.
Okay, that brings us to the end of our inspection. We've looked at the surface damage, we've tested the foundation, we've reviewed the new blueprints, and we've seen the architect's final rendering. It is time for Section 6, the final verdict. Here is our official inspection report.
All right, here's the bottom line. The bull case and the bear case are both crystal clear. On one side, the steel foundation is real. The record $31 million backlog provides future revenue visibility. But what's the margin on that backlog? We still don't know. They fortified the balance sheet by slashing debt, but they're still burning cash every single quarter. The CEO is showing extreme confidence with his own money at a premium. That's a great signal, but his cash alone can't fix a negative 73% gross margin. And they are carving out a powerful, defensible moat in the defense industry, a moat that depends entirely on flawless execution of their 2026 guidance, which, let's be honest, carries astronomical risk. It's a classic battle between a terrible present and a promising but highly uncertain future.
And that brings us to our final verdict. Velo3D is not a safe bet. This is not a finished, polished skyscraper. It is an active, noisy, and frankly, a dangerous construction site. This is a high-risk, high-reward turnaround play. It is only suitable for investors with a long-term horizon and a cast-iron stomach for extreme volatility and operational uncertainty. The potential view from the top is spectacular, but there's a very real chance this entire structure could come crashing down before they ever finish building it. We've run the stress test and we've presented the data. We've shown you the steel and we've shown you the cracks. The final decision, whether to invest in the foundation or to run from the facade, that rests with you. Thank you for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.